ago in the Washington Post. And he noted one of the challenges we face, and it certainly would seem relevant to the public-private partnership goal of removing toxic assets from the banking system, is that the assets are worth, if you will, in a market sense, 5 to 30 cents, but that to make the banks stable and successful, one would need to pay 50 to 60 cents. That's quite a gap and how does one attract a private partnership into that kind of scenario where they might need to pay far more than the assets are worth, and how does one go about tackling that? And I recognize this is an inherent dilemma you're working night and day to figure out.
Okay. Well, you're right about the problem, and the challenge is to try to make sure that with government financing, which financing is not available in these markets now, to provide a market clearing mechanism for these assets. And our judgment is that, again, if we provide some government capital and some government financing, you're going to provide something that does now exist, which is a way for this to get clearing. Now, again, what's sort of burdening the system now is the fact that there is really no financing available, no market for these assets, and therefore no real ability for banks that need to get rid of these things to do so in a way that's sort of sensible and effectively. But then this plan will address that. I wouldn't agree, though, with the precise examples you used in terms about what the price is of this and what's necessary to achieve this. But what you need to do is to get those market prices up again by making financing available. You want to make sure banks have a greater incentive to get rid of those assets.
If I understand your point, to some degree, the lower market valuation now is the result of the lack of demand, which is driven by the lack of credit to drive or clear the market.
Again, that's a key thing. Just to take the mortgage example, which is a simple example, if you had to sell your house tomorrow, not in 3 years, not after your kids go to college, but tomorrow, and nobody could get a mortgage, the price you would get would bear no realistic resemblance to what you might get in a normal condition. That's a simple explanation of what you're seeing across markets. And so providing the financing is a necessary, not a fully sufficient condition to do that. You know, the things that are driving uncertainty about these valuations is partly just concern about how deep the recession is and uncertainty about what the losses might be in that context. But a big part of this is the absence of financing.
A second issue that has been raised is whether the bondholders bank bondholders, if you will, should participate in the pain, if you will, and on the positive side, that participation is appropriate given the risk associated with their investment and the current status of the banks. And the opposite side, as I understand it, is that if the bondholders take a haircut, that it might decrease investment in other commercial or corporate bonds, damaging our effort to restore liquidity. How do you see that balance and how we approach this?
It's not a close call, Senator. It is necessary to protect the financial system and get recovery back on track for the markets to understand that we will do what's necessary to make sure that these major institutions can meet their commitments. And everything we're doing in terms of making capital available where it's necessary, providing support in terms of liquidity, funding, and guarantees, is to underscore that commitment to make sure these institutions can meet their commitments. That's necessary for them to be in a position to help provide the credit necessary for recovery, and that objective has to guide everything we do.
I appreciate your analysis. It is a little difficult to explain this in talking to taxpayers about why their investment shouldn't necessarily, to rescue the bank, shouldn't necessarily be in the front of the line, if you will, before the bondholders.
But that's right. But you know, our basic obligation again is to help protect the overall economy, overall financial system, at least cost to the taxpayer. And I'm very confident that that commitment I just described, that the President said in public and we've all said publicly, is the most effective, least cost way to the taxpayer for us to get out of this.
To restore, to sustain and improve liquidity.
Exactly.
Which is important in our economies everywhere.
The President said it best, economies recover a well-functioning financial system. Credit is the lifeblood of any economy. There is no path to recovery that doesn't start with a better foundation for the provision of credit.
One of the things that is very frustrating to me is I think many of the circumstances we're in right now could be avoided had we had reasonable rules of the road at both the retail mortgage market and in terms of Wall Street supervision. And at the retail level, something that was troubling is that folks going to their real estate brokers had a lot of protection against conflicts of interest, but when they went to their mortgage broker, their mortgage brokers often paid significant sums if they could steer their client, if you will, and our homeowner into a more expensive loan. Is it time to end and outlaw steering payments?
You're absolutely right that this crisis in part was caused by basic failures of consumer protection, and for some of the reasons we just discussed, we allowed people in this country to evade basic protections, and it is very important that we put in place a stronger set of basic rules of the road applied more evenly, enforced more carefully, so that this thing doesn't happen again. I completely agree with you. Of course, you want to do that in a way that's sort of careful and going to be effective, but the basic principle is right.
When you say you completely agree with me, does that include the detail that we should end steering payments? I like the word completely, by the way.
I meant to say I completely agree with the broad objective. I will look at that carefully. I do believe that I have to go back and look, but the Federal Reserve, in cooperation with the other supervisors, put out some very important provisions in terms of new regulations in the fourth quarter of last year that go some distance to addressing that problem. If they don't go far enough, we'll take a careful look at how to fix that.
Thank you. I'd love to work with your team in terms of that rule of the road. I see I'm over time now, and some other pieces of that consumer rule of the road. Thank you very much for your testimony.
Senator White.
Thank you, Mr. Chairman. Secretary Geithner, it's good to have you here. And